Good morning, everyone. Today, I want to talk about a remarkable policy experiment from Japan that offers invaluable lessons for Asian societies worldwide. This experiment is particularly noteworthy because it was significantly enhanced Japan's fiscal resources without the need to raise taxes, cut spending, sell assets, or increase debt. The policy I'm referring to is the 2014 reform of Japan's Government Pension Investment Fund, GPIF, initiated by former Prime Minister Shinzo Abe. The GPIF is the world's largest pool of retirement savings. Before the reform, it was heavily invested in Japanese government bonds, with 60% of its portfolio allocated there. However, Abe's reform shifted this allocation to 50% equities and 50% international assets. This strategic shift has yielded impressive results. According to Stephen Jan and Joanna Freer of Eurasian SLJ Capital, the fund grew from 137 trillion yen in 2014 to 226 trillion yen today, instead of the projected 168 trillion yen had the allocation remained unchanged. This extra return is equivalent to about 10% of Japan's GDP, or $370 billion. Now, let's explore the 6 key lessons we can learn from this policy experiment. Abe demonstrated significant leadership and resilience, despite criticism and periods of negative publicity when the fund's value dipped. He and his advisors stayed the course. This reform is one of Abe's proud legacies, showing the importance of steadfast leadership in policy implementation. The reform underscores the importance of focusing on net rather than gross public debt. Japan's gross public debt is famously high at 252% of GDP. However, its net public debt stands at 158% of GDP, partly due to the GPIF's assets. If the GPIF's funds had been used to cancel government bonds, Japan would have missed out on these significant returns, and net debt would be 10% points higher today. The GPIF shift illustrates a new approach to public finances. Governments, with their long-term obligations and ability to absorb risk, can benefit from investing in both public and private sector assets. This strategy can provide high returns compared to the traditional reliance on low-interest government bonds. The reform was executed conservatively with professional asset management and minimal political interference. This contrasts sharply with some UK local governments, which face financial troubles after borrowing heavily to invest in commercial property and other assets. Prudent management of public investment is crucial to avoid speculative risk. The GPIF model could be applied to other large pools of assets. For instance, Japan, along with other Asian countries, holds substantial foreign exchange reserves. These could be partially shifted into equities to achieve better returns, as seen with Hong Kong's management of its exchange fund. Early implementation of such reform is advantageous. The benefits accrued and risk are better managed over time, especially as the world's population continues to age. The current economic environment, with its low real interest rates, makes it a compelling time to think more like investors and less like debtors. In conclusion, Shinzo Abe's reform of the GPIF is a shining example of how innovative and well-managed policy changes can yield substantial economic benefits. As Asian societies face increasing fiscal pressures, the lesson from Japan's experience can guide other governments to think strategically about their long-term financial obligations and opportunities. Thank you for listening.